Imagine finding, well, a hidden gem in a crucial, surging industry, a company run by people whose wealth is directly tied to yours.
Sounds good so far.
Right. But now imagine that same gem comes with a significant price tag of volatility and some pretty serious headwinds.
Ah, the catch.
Exactly. That's the fascinating paradox we're unpacking today. Welcome to the Deep Dive, the show where we take your sources, distill the most important insights, and hopefully turn information overload into some real aha moments. Today, we're diving deep into Energy Services of America Corporation, or ESOA, that's ESOA, trading on NASDAQ. And this entire deep dive is built from an exhaustive fundamental analysis provided by one of you, our listeners, a report really aiming to dissect ESOA as a potential value investment.
And our goal today is pretty straightforward. We want to guide you through this complex material, highlighting the key pillars of the bull case, the undeniable risks, and what all this really means for anyone looking to understand this, well, intriguing small-cap company. We'll be breaking down its business, management, financials, market sentiment, really giving you a shortcut to being well-informed.
Great. And before we jump in, just a quick word from our research partner, Stock Analytics AI. They were instrumental in pulling together this analysis.
Right.
Remember, for just $4.99 a month, Stock Analytics AI members get priority deep dives on specific tickers. We're actually on a mission to cover all of the S&P 500 stocks over the next few months, and members get exclusive early access.
That's a big project.
It is. And if you just want a one-off deep dive like this one on ESOA, you can simply drop them a super thanks. And speaking of timely insights, make sure to stay tuned because we will be covering ESOA's upcoming earnings report that's August 11th within minutes of its release. You won't want to miss it.
Definitely a key date for this stock.
Absolutely.
Okay.
All right, let's unpack this. We're starting with part one, the foundation business, management, and financials. Chapter 1, the ESOA investment thesis, opportunity and risk. Okay, so ESO, as of August 8th, 2025, share price $9.91. Small cap contractor, energy, and utility infrastructure. The analysis says it's compelling, but high risk. Let's start with the compelling part. What makes it tick?
Right, so the bull case really rests on four key pillars, according to the source material. First up is a significant valuation disconnect.
Okay.
Now, the company trades at a low trailing PE, around 9.5, but honestly, that number is pretty misleading.
How so?
Because of a big one-time gain from a lawsuit settlement. It wasn't operational income. Even if you normalize it, the PE is still, modest. But here's the kicker. The only Wall Street analyst covering the stock has a price target of $21.
$21, that's more than double the current price.
Exactly. Over 100% upside implied. It suggests that at least one professional who's presumably done their homework sees way more value here than the market currently does. Maybe they're looking past the small cap noise.
Interesting. Okay, what's pillar number 2?
Second, strong insider conviction. Management and the board have exceptional skin in the game. We're talking CEO Douglas Reynolds owning 11%, Chairman Marshall Reynolds owning 9.1%.
Wow.
Their financial interests are directly aligned with shareholders. Their wealth is tied to the stock going up, not just salaries. Plus, there have been recent insider purchases, which always signals confidence.
Always good to see. Okay, third pillar.
Third, favorable industry tailwinds. This is a big one. ESOA is positioned to benefit from what looks like a multi-decade investment cycle in U.S. energy infrastructure.
Because demand is just exploding, right? AI, EVs.
You got it. AI data centers, manufacturing, onshoring, electric vehicles are all driving up electricity demand like crazy after years of flatness. Our grid is old, it's strained, and that creates a critical, non-negotiable need for ESOA's services.
And natural gas. Isn't that a big part of their business too?
It is, and natural gas remains a vital bridge fuel in the energy transition, so demand for their pipeline services looks pretty solid for the long haul too.
Makes sense. And the last pillar.
And finally, number 4 is a proactive management strategy. They aren't just sitting back. Leadership is actively working to close that valuation gap we talked about.
How?
They use a disciplined growth by acquisition strategy, buying complementary businesses to expand service and geography. Think the 2022 acquisitions of Tri-State Paving and Ryan Construction Services?
Right.
And crucially, they hired an investor relations firm, Three Part Advisors, back in March 2024. Management explicitly said this was to unlock value because their story had gone under the radar. That's a very deliberate move to get noticed.
Okay, that's a pretty convincing bull case. Valuation disconnect, insider alignment, industry tailwinds, proactive management. But, like we teased at the start, there's always the flip side. What are the major risks here? Where could this go wrong?
Absolutely. The bear case is just as important to understand. First, there's the inherent small cap volatility and low liquidity. Market cap around $177 million. That means the stock price can swing wildly.
Yeah, it makes it tough to trade sometimes.
Exactly. Getting in or out of a large position without moving the price yourself, it can be a real challenge.
Okay, risk number one. What else?
Second, earnings quality and volatility.
Okay.
This is huge. That FY24 net income of $25.1 million, massively inflated by that $15.6 million lawsuit judgment.
The one-off gain.
Right. So the headline EPS wasn't sustainable. And there's a history of really extreme earnings volatility. Remember Q2 2025? They reported a loss of $0.41 per share when the street expected an A-rate 8-cent profit.
Ouch. That's a huge miss. Minus 612% surprise.
Yeah, and the stock dropped nearly 17% in a single day. That kind of unpredictability makes investors nervous, understandably.
For sure. Okay, what's the third major risk?
Third, they face macroeconomic headwinds. This is a capital-intensive business. Things like trade tariffs, especially the 50% tariff on steel and aluminum.
That hits their costs directly.
Directly squeezes margins on their projects. And then there's the potential indirect impact. Yale's Budget Lab analysis suggests those 2025 tariffs could cause a 3.6% contraction in the construction sector overall.
Meaning their customers might pull back on projects.
Potentially, yeah. Delays, cancellations. It could definitely dampen demand.
Okay, and the final risk?
And fourth, there's customer and project concentration. Their revenue can be lumpy. It can depend heavily on a few large projects at any given time. For example, the decline in their gas and petroleum transmission segment in FY24, that was mainly because one big project wrapped up.
And they didn't have another one immediately lined up to fill the gap.
Exactly. So it makes forecasting tricky and adds to that earnings volatility picture.
Okay, so we've got the opportunity versus the risk laid out. It really hinges on execution and maybe how tolerant you are of those bumps in the road. Let's talk about the people in charge. Chapter 2, management quality and shareholder alignment. Who's steering this ship, and are they rowing in the same direction as shareholders?
This is a really interesting aspect. It's quite family-centric, but also very experienced. Marshall T. Reynolds has been chairman since day one. His son, Douglas V. Reynolds, has been CEO since 2012. And another son, Jack M. Reynolds, is also a director. Now, that family focus can sometimes be a concern, but here it seems to provide a long-term perspective. Plus, CEO Douglas has over 12 years running the show, and the CFO, Charles Krimmel, has been there since 2008. That's stability.
And you mentioned the board got stronger recently.
Yes, a really positive step in April 2022. They appointed 3 new, highly qualified independent directors: Amy Abraham in energy marketing, Patrick Farrell in energy infrastructure investing, and Mark Prince in finance. He's now the audit committee chair.
That sounds like a good move for governance.
Definitely. It strengthens oversight and makes the company more attractive to institutional investors.
And we touched on skin in the game. But let's talk compensation. How are they paid? Is it set up for the long haul?
This is where that alignment really comes through. For FY24, the CEO's total compensation was about $269,400.
That sounds quite low, actually.
It is. Significantly below the average for CEOs of similar-sized U.S. companies, which was around $1.66 million. The real incentive isn't the salary.
It's the stock ownership.
Exactly. That huge 11% personal stake means his primary reward comes from the stock price going up. That drives a focus on long-term value creation, just like any other shareholder would want. It's an owner's mindset.
Makes sense. And who else owns significant chunks? What does the overall shareholder base look like?
The ownership structure is pretty compelling. You've got that high insider. Ownership insiders hold stakes worth about $46 million in a $177 million company. That's serious conviction.
Yeah, definitely.
Then you have significant and growing institutional ownership. Institutions control about 41% of the stock. The top 14 holders, insiders, and institutions combined own 51%.
So a majority is locked up with long-term holders.
Pretty much. And importantly, more institutions have been increasing their positions than decreasing them recently. Big names like Huntington National Bank, Vanguard, they're involved. The remaining 33% is held by the public.
So that structure probably discourages short-term activism.
It tends to, yes.
Yeah.
It supports a longer-term focus, which aligns with the management strategy of unlocking value over time.
Okay, fascinating stuff on the people side. Let's get into the numbers now. Time for Chapter 3, a deep dive into the financials. What's the story the financial statements tell us? How healthy is this operation?
Looking at the recent history, specifically comparing FY 2023 to FY 2024, you see pretty robust growth. Total revenue jumped 15.7%. from about $304 million to $352 million.
And was that across the board?
Mostly, yeah. Strong increases in electrical, mechanical in general, and also gas and water distribution. Those offset a decline in the bigger gas and petroleum transmission segment we mentioned earlier.
Okay. And what about profitability? Did margins improve?
They did, significantly. Gross profit surged 35.7% to $50 million. That's growing roughly twice as fast as revenue, which is what you want to see.
Nice.
Gross margin expanded from 12.1% to 14.2%, mainly thanks to a profitable new electrical project and income from operations, up an impressive 52.3% to nearly $20 million. Strong operational leverage there.
That sounds fantastic.
Nice.
But hang on, that lawsuit gain, we need to talk about how that impacts the bottom line, right? How much of that profit was really from operations?
You're absolutely right to bring that up again. It's critical. While they reported that $25.1 million net income for FY24, a huge 239% increase.
Yeah.
That was heavily inflated by the non-recurring $15.6 million lawsuit judgment. That wasn't core business.
So we need to normalize it. How does that look?
If you normalize it, basically take the pre-tax income, subtract the lawsuit gain, and apply their tax rate, the true sustainable net income is closer to $13.4 million.
Okay, $13.4 million versus the reported $25.1 million. Big difference.
Huge difference, and it impacts the valuation perception. The market might see that reported PE of around 7.0x and think it's super cheap.
But the real normalized PE is?
Closer to 13.2x. Now, that's still an attractive multiple for a company that grew operating income over 50%, but it's not the screaming bargain the headline number suggests. You have to look deeper.
Got it. Very important distinction. Now, how efficiently are they using their capital? Let's talk return on invested capital, ROIC. I heard there might be conflicting numbers here.
Yeah, you might see different figures depending on the source and time frame. Guru Focus, which does a detailed calculation, shows a strong FY24 ROIC of 15.03%. That reflects that good operational performance in fiscal 24.
Bet.
But their trailing 12 months, TTM ROIC, is only 7.36%. That lower number includes the big loss they took in Q2 2025, which really dragged it down.
So it shows the volatility again?
Exactly.
Yeah.
And the key comparison is ROIC versus their cost of capital, the WACC, which Guru Focus estimates at 8.20%.
Okay.
In FY24, their ROIC of 15% was way higher than their 8.2% WACC. That means they were creating economic value. Good sign.
But the more recent TTM figure?
The TTM ROIC of 7.36% is below the WACC. That highlights the risk strong years can be offset by weak quarters. It underscores that operational inconsistency.
Right. Okay, finally for this section, let's quickly touch on the balance sheet. Are they solid? Too much debt?
Generally, the balance sheet looks pretty healthy. Total debt is around $33.9 million against shareholders' equity of $58.7 million. That gives you a debt-to-equity ratio of about 0.58, which is quite manageable.
Even if some sources show a higher DE, like near 1.
Even then, it wouldn't necessarily be alarming for this type of capital-intensive business. They don't seem overly leveraged. And their short-term liquidity looks good, too. Current ratio of 1.31, quick ratio of 1.24. They can cover their immediate bills.
And cash flow.
Strong. Generated a solid $28.48 million in cash from operations over the last 12 months. That shows the underlying business throws off cash, even with the accounting ups and downs.
Okay, that covers the foundations. We understand the business, the management, the financials, the core thesis, and risks. Let's zoom out now. Part 2. Strategic positioning, macro environment, operations, value, and sentiment.
Right, putting it all in context.
Exactly. Starting with Chapter 4, the macro environment. Tailwinds and headwinds. What are the big picture forces shaping ESOA's world?
Well, the tailwinds are pretty powerful, as we touched on. The 2025 outlook for energy and construction services look very strong for companies like ESOA. You got that surging electricity demand.
And the AI, EVs, onshoring trifecta.
Precisely. After 2 decades of flat demand, it's skyrocketing.
Yeah.
The grid is aging, it needs upgrades, maintenance, expansion. That's core business for ESOA. And it's not really optional spending for the utilities.
And the natural gas side holds up too.
Yes, it remains an essential bridge fuel. So long-term demand for their pipeline services looks secure. Plus, you have supportive policy things like the Inflation Reduction Act pumping billions into energy projects, and generally a policy environment favoring infrastructure investment.
Okay, that demand picture sounds incredibly strong. But what about the challenges, the headwinds?
There are definitely significant headwinds, mainly around the regulatory and tariff landscape. The federal regulatory scene is a bit, well, unsettled. Potential policy changes create uncertainty. State regulations also add complexity.
But the big one seems to be tariffs.
Absolutely. Those steep tariffs, up to 50% on steel and aluminum, are a direct hit to their material costs. That squeezes margins. Tariffs from Canada and Mexico also disrupt supply chains. It's a real operational headache.
And there's an indirect impact, too, right, on overall construction demand.
Yes, that Yale Budget Lab analysis is concerning. It projects that 2025 tariffs could cause a 3.6% contraction in the construction sector overall.
Meaning ESO's customers might tighten their belts.
Exactly. They might delay or cancel projects if their own costs go up or the economy slows.
Hmm.
So tariffs hit ESO directly on costs and potentially indirectly on demand.
So it's this constant push and pull, fundamental need driving demand, but economic and regulatory friction pushing back. A real tension.
That's a great way to put it.
Okay, let's pivot to exactly what ESOA does. Chapter 5, the business of energy infrastructure, operations and moat. How do they actually operate, and do they have any kind of competitive protection?
So at its core, ESO is a contractor. They build and maintain stuff for the energy, utility, and industrial sectors in the U.S. They're based in Huntington, West Virginia.
And they focus geographically.
Yeah, mainly the Mid-Atlantic and central regions, West Virginia, Ohio, Pennsylvania, Kentucky. That concentration allows for deep market knowledge and operational efficiency.
What kind of services specifically?
They break it down into segments. Gas and water distribution, that's local pipelines. Gas and petroleum transmission, bigger interstate pipelines. And electrical, mechanical in general, which is a bit of a catch-all. Substations, industrial piping, solar installations, even broadband infrastructure.
So pretty diverse within energy infrastructure. Who are their typical customers?
Big utility companies, private natural gas firms, industrial clients, kind of the usual suspects in that space.
And what's their strategy for growing that business?
It's quite proactive. A key part is growth through acquisition. They've bought companies like Tri-State Paving and Ryan Construction Services to add capabilities and expand their footprint, aiming to be that one-stop shop.
Right.
Another huge pillar is unlocking shareholder value. We mentioned the IR firm hiring. That's a direct signal. They think the stock is undervalued, and they want to get the story out. They attend investor conferences trying to reach those institutional buyers.
Makes sense.
And underlying it all is a focus on operational excellence, safety, quality, production. In this industry, your reputation for reliability and safety is paramount.
Is that reputation, that local focus, enough to give them a competitive advantage, a moat? It sounds like a competitive field.
It is very competitive and fragmented.
Yeah.
You've got giants like Jacobs Solutions down to small regional players. ESO doesn't have a classic wide moat, like a patent or dominant brand.
So what protects them?
It's more of a local moat built on a few things. One is regional density and expertise. Being deeply embedded in those mid-Atlantic central states gives them logistical advantages and local know-how. Two is sticky customer relationships. Especially with utilities, trust, reliability, and a proven track record are huge. Switching contractors is risky and costly, even if it's just intangible costs. That creates stickiness.
And that acquisitions help here.
Yes, through those integrated service offerings. Being able to bundle different services makes life easier for the client. One point of contact, single accountability. That adds value.
How do they stack up against peers on valuation metrics like price to sales or PE?
Looking at the peer comparison table provided in the source, their price to sales ratio, around 0.48x, is actually quite good, in line or better than most peers. And that normalized PE of about 13.2x looks significantly more attractive than profitable peers like Orion Group or Natural Gas Services Group, which trade much higher.
So relatively cheap compared to others.
It appears so on those metrics. Their debt might be a bit higher than some peers, but the valuation seems reasonable, even attractive in context. It's not a fortress mode, but they have competitive advantages.
Okay, this brings us to the million-dollar question, or maybe the $9.91 question right now. Chapter 6. Intrinsic value. What is ESOA worth? Let's try and pin down a number.
Right. Looking at relative valuation first, that normalized PE of around 13.2x, it's higher than where ESOA traded in FY22 and FY23.
But justified by the better performance in FY24.
Arguably, yes. Operating income grew over 50%, remember? And as we just said, compared to peers, it still looks attractive. Their price to book of 3.2x isn't deep value, but it's somewhat supported by that high, though inflated, reported ROE.
Okay, but relative value only tells you so much. What about a more fundamental approach, like a discounted cash flow?
Yes, the discounted cash flow, DCF valuation, tries to estimate intrinsic value by projecting future cash flows. It's useful for growth stories, but highly dependent on assumptions.
So what assumptions did the analysis use?
The model presented used, I'd say, reasonably conservative assumptions. Revenue growth at 8% for 3 years, then slowing down, an operating margin assumption of 4.5%.
Now wait, 4.5%, that's below their FY24 actual margin of 5.6%, right?
It is. It's also above the recent TTM margin of 2.9%. So choosing 4.5% builds in a margin of safety, assuming margins might compress a bit from that FY24 peak, but stay better than the recent trough.
Okay, conservative margin, what else?
A discount rate, WACC, of 8.20% and a terminal growth rate of 2.5%, basically in line with long-term economic growth.
And plugging all that in, the DCF result is
Approximately $8.26 per share.
$8.26. Okay, so let's talk margin of safety. The DCF says $8.26. The market price is $9.91. What's the conclusion?
Based on this conservative DCF model, the stock is currently trading at a premium to its estimated intrinsic value.
Meaning no margin of safety at the current price.
Not based on these assumptions, no. However, and this is a big however, the outcome is very sensitive to that operating margin assumption.
How sensitive?
If you assumed, say, a 5.5% operating margin instead of 4.5%, so closer to their FY24 actuals,
Then what happens?
the intrinsic value jumps to around $13.50 per share. And that would imply a 27% margin of safety from the current price.
Okay, so it really boils down to whether you believe they can sustain those stronger margins.
Precisely. An investment at $9.91 is effectively a bet that they can operate closer to that 5.5% margin level, or perhaps even better, which is clearly what that lone analyst with the $21 target believes is possible. Our $8.26 is a more cautious take.
That makes the upcoming earnings report even more crucial then, to see how margins are trending. Okay, finally, let's gauge the mood. Chapter 7. Market sentiment and near-term outlook. How is the broader market feeling about ESO right now?
Well, as we said, Wall Street's view is thin because not many analysts cover it. But the one who does, Lake Street, is bullish. Buy rating, $21 price target.
That huge gap again, $9.91 versus $21.
Exactly. It highlights the core debate. Is the market right to penalize it for the small size, low liquidity, and recent earnings miss? Or is the analyst right to look through that noise to the long-term potential fueled by those industry tailwinds and insider alignment? That's the valuation gap management is trying to close.
And the biggest near-term catalyst is definitely that Q3 2025 earnings call on August 11th.
Absolutely pivotal. Wall Street expects EPS of $40.12 on about $88 million in revenue. That would signal a return to profitability after the Q2 disaster.
And the stock tends to react strongly to earnings, right?
Extremely strongly. We saw the nearly 17% drop after the Q2 miss. But positive surprises in prior quarters led to huge jumps like 17% or even 37% gains.
Wow.
It's high stakes. A beat could really validate the bull case and maybe start closing that valuation gap. A miss. That would reinforce all the skepticism.
Any other sentiment indicators worth watching?
Yeah, a couple of technical and sentiment points. From a technical perspective, ESO is hovering near its 50-day moving average, but still below its 200-day moving average. Getting and staying above that 200-day, around $11.13, would be a more bullish signal.
Okay.
And short interest is pretty notable at 6.77% of the float. That translates to about 5.6 days to cover.
Meaning a decent number of traders are betting against the stock.
Yes, likely focusing on the Q2 miss and those macroeconomic tariff concerns. But that high short interest also creates the potential for a short squeeze.
If good news hits.
Exactly. If earnings surprise positively, those short sellers might rush to buy back shares to cut their losses, which can rapidly drive the price higher. It adds another layer of potential volatility both up and down.
Okay, we've covered a lot of ground. Let's try to synthesize this. What does this all mean for you, the listener, trying to make sense of ESOA?
I think the original analysis summed it up well. ESOA is a compelling, albeit high-risk, value proposition. It really fits that classic value investor mold if you have a long-term horizon and, maybe most importantly, a significant tolerance for volatility.
Right.
You have an understandable business in a vital sector, management that's clearly aligned with shareholders via huge ownership stakes, and a market price that seems disconnected from its normalized earning power, especially when you consider those industry tailwinds.
So reiterating the positives, it's a direct play on the multi-decade need to upgrade America's energy infrastructure. Demand drivers like AI and EVs aren't going away. Management is actively trying to get the market to notice, and they're incentivized like owners.
That you absolutely cannot ignore the risks. Its small size means volatility. The project-based revenues are lumpy and hard to predict quarter to quarter. And macroeconomic risks, especially those tariffs, are real threats to margins and potentially demand.
And our conservative DCF didn't show a margin of safety at the current price.
Correct. An investment today implies a belief that they can sustain higher margins than our conservative model assumed, perhaps closer to that strong FY24 performance, or that the market will eventually overlook the short-term noise and re-rate the stock based on the long-term story. It's not for the faint of heart.
So maybe the final provocative thought for you to consider is this. Ultimately, an investment in ESO is a bet. It's a bet that the market will eventually recognize the durable value of its operations, the undeniable long-term growth in its industry, and look past the quarterly bumps and one-time events. It's not for the conservative investor, perhaps, but maybe for the diligent one who sees potential for a significant re-rating in a vital yet overlooked part of the market. It's really a bet on American energy infrastructure's future, led by a team sharing the risks and rewards right alongside you.
Well said.
If you found this deep dive valuable, please remember to like and subscribe to Stock Analytics AI. For just €4.99 a month, members get priority deep dives on tickers. We're covering all of the S&P 500 stocks over the next few months, and members get that exclusive early access. And you can always get a one-off deep dive, just like this one, by dropping us a super thanks. Your support is what allows us to keep doing these. And just a quick note, the research and analysis presented in this deep dive were generated using advanced AI. We've meticulously reviewed the sources to ensure accuracy and impartiality, providing you with factual content for your informed decision-making.